Hello everyone and welcome back. Today we are going to talk about how an IUL indexes its growth or credits its growth rather versus how an index fund does. The most common fund that everyone follows is the S&P 500, so we're going to use that today. It's also the one that's been performing really the best over the last few years. I'm going to show you the difference between investing directly into an S&P 500 index fund or investing into an IUL that is indexed to the S&P 500, and let's see the difference in terms of how much money we have at the end. Now, one of the big differences is that with the IUL, you are not actually invested directly in the index. Instead, the fund managers use options to index to the index, but your funds are not actually in the index. And so what that allows the fund managers to do is to, when the index goes up, they provide you with the same growth. And when the index goes down, you are protected from loss. So the companies, insurance companies, when they do this, they have what's called a minimum floor. Sometimes that amount is 0%, sometimes it's 0.25%, sometimes it's 1%, but generally, most commonly, it's going to be 0%. But I do work with some funds who will give you a little bit more than that. Here's a little chart, and this shows the S&P 500 between the years of 1998 and 2010. I have some more data to show you in a minute, more recent. But this gives you an idea of what happens. The red line here is the S&P 500 during those years. So as you can see, it went up 10%, up 8%, then it dropped back 49% actually over those 2 years before increasing at 8% and then continuing to increase until there was another dip, the 2009 market crash here. The end of this period, if we had invested $100,000 at the beginning of this period in 1998 and just left our funds there and not made any changes, we would have at the end of that period $108,789. Okay, and then here there's a little note about you would lose 30% to 50% of this in tax, but we're not worrying about that today. That's another video. All right, so then let's look at the blue line. So the blue line is our index universal life policy that is indexed to the S&P 500 but not in it. Here we see it goes up exactly the same as the S&P 500, 10%, 8%. Then in 2000, when we had that market decline, the IUL does not go down. It stays at 0% and 0%. Then in 2002, when the market starts to go up again, the index universal life also goes up in line. Most likely there's a cap. However, in these years, it didn't go above the cap. So we don't see any capping needed. Then in 2009, 2010, when we had that market fall again, our index universal life stays level. And then it goes up again the next year when the market goes back up. Now, in this fund, we have $244,872 at the end of that period compared to $108,000 down here. So we're actually 250% more in our IUL fund than in our S&P 500 index fund. All right, so let's look at some more recent data and see what happens there. On this slide, I've got the detail, right? So this time we're investing at the beginning of 2008, $100,000 in each fund. And you will see that the S&P 500 in 2008, by the end of 2008, had dropped 38.5%. So in our S&P 500 fund, our balance also dropped to $61,500, which you can see here. Our IUL, because we have a 0% floor on this fund, has a credit rate of 0%, which means our balance stays at 100%. All right, so 2009, the market bounces back and increases by 23.45%. That means our balance also goes up, but from that lower base. So we're now at just under $76,000 here. Our IUL, this particular one, has a cap on it at 12.5%. That's pretty typical. Most funds, that cap somewhere between 12 and 14%. So this fund goes up 12.5%, so we're now at $112,500. In 2010, the market goes up 12.78%, so our S&P 500 balance increases to just over $85,500. Our IULs, again, capped at 12.5%, so it increases to $126,562. In 2011, the market ended the year the same level as it opened, so 0% crediting on both sides. Both accounts stay the same. In 2012, we had the S&P increase by 13.41% over the year, which means our S&P 500 balance goes up to 97,123. On our IUL side, we are capped at 12.5%, so our balance goes up to 142,383. 2013, our S&P 500 went up 29.6%, so that was a nice big jump there. That pushes our S&P 500 dollar balance up to 125,871. On our IUL side, we are again capped at 12.5%, and that pushes our IUL balance up to 160,000. On our IUL side, we are again capped at 12.5%, and that pushes our IUL balance up to 160,181. Okay, so 2014, S&P 500 rises 11.39% over the year, and that pushes our balance up to 140,208, starting to catch up again. Our IUL is the same. It credits at 11.39%, which pushes its balance up to 178,425. The next year, 2015, there was a small dip. So the market dropped by 0.73% over the year. That drops the balance in our S&P 500 fund to 139,184. Obviously, we still have our 0% floor over here on the IUL, leaving our balance the same. Okay, so 2016, the S&P 500 goes up 9.54%. That means the balance in our S&P 500 fund is now 152,462. Then over here on the IUL, we get the same 9.54% is credited, bringing the balance to 195,447. Over here on 2017, the market jumps 19.42% over the year, bringing our balance up to $182,070. And then with the IUL, capped again at 12.5%, bringing our balance up to $219,878. So the difference is a little bit less than $40,000. The other thing, as per my previous video, is that this IUL money is available tax-free through policy loans, whereas this investment that has been made either from pre-tax dollars or from post-tax dollars, but not inside a life insurance policy, any gain are taxable. Okay, so that's today's video talking about the benefits that you get from crediting, the way an IUL credits versus having money actually in the market. And so the reason is that the IUL funds are not invested in the actual stocks. They are indexed to the stock index using options. And if you're interested to learn more about how IULs might work for you, please feel free to reach out. You can find me at thelipnickiagency.com, and I'll be happy to answer any questions or make an illustration for you personally.